Fibonacci tools survive because they answer two questions every trend trader needs answered. After an impulse, how deep can the pullback go before the trend is in doubt? And once price resumes, how far might it travel before exhaustion? Retracements give you pullback zones for entries. Extensions give you projection zones for exits. In this episode, we'll cover the math, the levels, real signals, confluence, and the pitfalls that quietly destroy edges. The Fibonacci sequence is 1, 1, 2, 3, 5, 8, 13, and so on, each term the sum of the prior two. Divide any term by the next, and the ratio converges to 0.618, the golden ratio's inverse. Divide by the term two steps ahead, you get 0.382. Square root of 0.618 gives 0.786. These ratios, plus the practical 50% level, define our retracement grid. Anchor from a clear swing low to a clear swing high in an uptrend, or the reverse in a downtrend. Use the highest high and lowest low of the impulse, including wicks, unless you have a documented reason to use bodies. The shallow zone, 38.2, suits strong trends. The golden pocket between 61.8 and 65% is the classic value area. 78.6 is the last defense level before the move is invalidated. In strong trends, price often holds the 38, barely tagging deeper levels. In healthy trends, the 50 to 61.8 zone is where institutional buyers reload. A break and close beyond 78.6 warns that the prior impulse was distribution, not accumulation. Treat Fibonacci levels as zones, not lines. Volatility adjusts the band by adding a fraction of average true range on either side, so noise doesn't knock you out of an otherwise valid setup. Extensions project beyond the original swing using the same ratios stretched out. The 1.272 and 1.618 are the workhorses for the next leg of a trend. 2.618 marks parabolic exhaustion. To draw them, mark the impulse low and high, then the pullback low, and project from there. Use extensions to scale out, not to predict exact tops. Partial at 1.272. Trail the runner toward 1.618. Don't blindly bid the level. Wait for confirmation inside the zone. Look for a bullish engulfing, a hammer with volume, or a lower timeframe break of structure back in the trend direction. Place stops just beyond the 78.6 or beyond the swing low if you entered shallower. Size by the distance to invalidation, not by gut. The level gives you location. The candle gives you timing. Without the trigger, you are guessing, not trading. Here is Apple on the daily. Anchor the most recent significant impulse low to its swing high. Watch how price pulls back into the golden pocket, reacts, and then resumes. Apply the extension from the same anchors, and you can see 1.272 and 1.618 acting as natural profit-taking shelves where momentum stalled. This is exactly what we just sketched, except the market rarely delivers it this cleanly twice in a row. A Fibonacci level alone is a weak signal. Stack it with structure. A 61.8 that aligns with a prior breakout zone, a rising 20 or 50 exponential moving average, the volume-weighted average price, or a higher timeframe order block becomes a high-probability node. Add an oscillator like the Relative Strength Index showing a bullish divergence into the zone, and the asymmetry tilts further in your favor. 3 independent reasons. Beat one elegant ratio every single time. Fibonacci is subjective. 2 traders pick 2 different swings and get 2 different grids. It is also lagging in the sense that you need a completed impulse to draw it. In choppy, range-bound markets, every retracement level gets violated because there is no dominant trend to retrace. And in news-driven gaps, price ignores ratios entirely. Except that the tool is descriptive geometry, not predictive law. If price slices through the 78.6 on volume, the setup is dead. First, anchor shopping. Don't redraw the tool until it fits your bias. Pick a rule and stick to it. Second, ignoring the higher time frame trend. Retracement entries against the daily trend are counter-trend trades and should be sized accordingly. Third, over-reliance on the 50% level, which is not even a Fibonacci ratio. Fourth, projecting extensions from the wrong pullback or from internal noise. Define your anchors before the trade in writing, and your statistics will improve. Recap. Retracements locate pullback entries, with the golden pocket as the value zone and 78.6 as the line in the sand. Extensions project exits at 1.272 and 1.618. Always pair the level with a candle trigger and outside confluence. Tomorrow, pick 3 trending charts, draw your grids, and journal whether price respected your zones. Build the pattern recognition before you risk capital. This is education, not financial advice. Trade your own plan. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.